We are currently witnessing what historians will later call a structural pivot point. While most of the world was enjoying their weekend, the geopolitical landscape of the Middle East and by extension, the energy and monetary foundations of the West was decapitated. This isn't just another headline in a 2-4-hour news cycle. This is the official confirmation of the death of Iran's Supreme Leader Ali Khamenei and former President Mahmoud Ahmadinejad. When the state broadcaster uses the word martyrdom, the game changes from diplomacy to existential kinetic warfare. The reason I call this the source code is that while the mainstream media focuses on the politics, we focus on the price discovery that happens when the doors of the New York Stock Exchange are locked. We are seeing a massive black swan event, an unpredictable occurrence that carries an extreme impact. However, for those of us watching the dark markets and crypto-collateralized physical assets, this wasn't entirely unpredictable. The system was already brittle. These strikes were simply the hammer that shattered the glass. In the traditional financial world, there is a dangerous myth that markets close on Friday and open on Monday. This is a legacy delusion. Money never sleeps, and neither does risk. While Western traders were offline, the physical crypto bridge, like PAXG, and the Asian physical premiums were screaming. We saw gold hitting $6,000 an ounce in dark markets. That is not a typo. That is a $700 plus premium over where the paper markets claimed the price was on Friday. This disconnect represents the great decoupling. On one side, you have the Western financial system, which relies on paper contracts, leverage, and the hope that the Strait of Hormuz stays open. On the other side, you have the source code reality, physical gold, the ultimate monetary reset hedge, physical silver, the industrial necessity, oil, the energy that cannot be printed. If you are holding paper assets, ETFs that aren't backed by physical delivery, or digital digits in a bank that relies on global stability, you are currently flying blind. The Miles macro philosophy is about understanding necessity versus sentiment. Most stocks trade on sentiment. They trade on how people feel about the future. But when 20% of the world's oil is functionally frozen and the leaders of a regional superpower are eliminated, sentiment goes out the window. Necessity takes over. This introduction isn't just a warning. It's a call to look at the data. We are going to look at why the UAE has become a war zone, why insurance companies have more power than aircraft carriers right now, and why the Shenzhen premium on silver is the most important number in your portfolio. Stay grounded. Invest with logic, not hype. We are moving into part 2, where we analyze the kinetic escalation and the red lines that no longer exist. This isn't speculation. This isn't a rumor floating around a Telegram channel or a leaked memo. This is official confirmation from the Iranian state broadcaster. The source code of Middle Eastern stability has been rewritten overnight. Iranian state media has officially confirmed that Supreme Leader Ali Khamenei has been killed following coordinated U.S.-Israeli airstrikes. In the same breath, they announced the death of former President Mahmoud Ahmadinejad in a separate, surgical strike. When you remove the two most powerful figures in a regional superpower, you aren't just sending a message, you are initiating a regime-ending objective. For years, the red lines were the invisible boundaries that kept this shadow war from exploding into a global conflagration. Those lines have been incinerated. Many analysts predicted that the death of the Supreme Leader would lead to a period of mourning or internal chaos. They were wrong. Instead, we witnessed a massive, coordinated retaliation that stretched the limits of modern air defense systems. Since yesterday, Iran has launched 165 ballistic missiles, 2 cruise missiles, 541 drones. While the paper markets were closed, the kinetic markets were pricing in total war. Yes, Western tech is impressive. 152 ballistic missiles were intercepted, and 56 drones were knocked out of the sky. But in asymmetric warfare, perfection is the only metric that matters. 35 drones hit land. 21 of those struck civilian targets just this morning. The UAE, once considered the Switzerland of the Middle East and a safe haven for global capital, has been turned into a war zone. We are looking at 3 dead, 58 injured, and a psychological blow to the Dubai-Abu Dhabi hub that no insurance policy can cover. The escalation didn't stop at civilian infrastructure. Iranian Revolutionary Guards confirmed via state media that they targeted the U.S. aircraft carrier Abraham Lincoln with 4 ballistic missiles. Whether those missiles were intercepted or scored, a mission kill is currently shrouded in a fog of war, but the intent alone is a paradigm shift. In the old world, attacking a U.S. carrier group was the ultimate do-not-cross line. In the new world, the world where the Supreme Leader has reached martyrdom, Iran has signaled that there are no red lines anymore. They are not bowing. They are swinging back with everything they have left. Macro note: When a carrier group is targeted and the unsinkable ports of the UAE are burning, the global risk premium doesn't just tick up, it teleports. Israel has now explicitly stated that regime change is the goal. This is no longer about deterrence or mowing the grass. This is a sustained military operation designed to dismantle the Iranian state. Meanwhile, the Houthis have resumed attacks in the Red Sea, creating a multi-front choke point crisis that effectively traps global trade in a vice. The world is watching the headlines, but we are watching the structural fallout. In the next section, we're going to look at the Great Freeze, how the insurance industry just did what the military couldn't, effectively shut down the Strait of Hormuz. While the world is fixated on the smoke rising from Tehran, the real kill shot to the global economy is happening in a narrow stretch of water just 21 miles wide at its narrowest point, the Strait of Hormuz. Roughly 20% of global seaborne oil trade flows through this choke point. If you want to understand why the macro reality is diverging from the sentiment reality, you have to look at the insurance markets. In the modern world, you don't need to sink every ship to stop the flow of energy. You just need to make those ships uninsurable. The death of the war risk policy. Every vessel traveling through Hormuz must purchase war risk insurance. This protects shipping companies from the astronomical costs of attacks. But here is the source code truth. Insurance is a business of probability, not charity. Following the attacks on the Skylight, a Palau flag tanker, and the MKD Vion, both of which are currently on fire near the entrance of the strait, the insurance market has effectively nuked the region. Cost surge. Insurance premiums for a $100 million oil tanker have jumped from $250,000 to $375,000 per voyage overnight. Refusal of coverage. Many insurers are simply walking away. If a ship isn't covered, it doesn't sail. Period. This has created what I call the functional freeze. The waterway is technically open, but it is effectively a dead zone. Right now, over 150 tankers have dropped anchor in open waters, refusing to move. They are sitting ducks off the coasts of major Persian Gulf producers because Maersk and other giants have suspended all transits. We are looking at a violent, negative supply shock. Approximately 20 million barrels per day of oil are now frozen. But it's not just oil. It's the heat of the world. 100% of Qatar's world-leading LNG exports are suddenly blocked. Brent oil is already trading up 8 to 10%, holding steady around $80 per barrel despite the weekend. But that's just the paper price. In the real world, the scarcity hasn't even hit the gas pumps yet. When it does, $80 will look like a bargain. Iran's strategy is a textbook example of asymmetric maritime warfare. They aren't trying to win a naval battle against the U.S. Fifth Fleet. They are trying to win an economic war by making the region's infrastructure indefensible. They have realized a terrifying truth. You can protect a ship with a destroyer, but you can't protect a 1,000-acre port from a swarm of $20,000 drones. Iran isn't just targeting hulls. They are targeting cranes and terminals. Asterisk Jabel Ali, Dubai. This port handles 60% of all UAE imports. By striking Jabal Ali with drone swarms, Iran has crippled the non-oil economy of Dubai. You can't run a global financial hub if you can't unload a shipping container. Duqm, Oman. This port was specifically built as a bypass for Hormuz risks. Iran hit it anyway, proving there is no safe exit. Mina Salman, Bahrain, home to the U.S. Fifth Fleet. By attacking here, they hit the nexus where military power meets commercial logistics. Haifa, Israel. Managing vital energy imports. This strike ensures that the energy war is felt on both sides of the Mediterranean. Miles Macro Insight. Ports are the real battleground. A carrier group is a formidable weapon, but it cannot intercept the economic paralysis caused by a burning port crane. Every Gulf exporter is now repricing their risk, and the global tanker fleet is being revalued overnight. The Iranian Revolutionary Guards are demonstrating that they don't need to win a war in the traditional sense. They just need to make the cost of doing business in the Middle East so high that the global economy snaps. When you combine the functional freeze of the strait with the ignition of the ports, you get a total blockage of the energy arteries of the world. In the next section, we are going to look at the Asian contagion, the nations like Japan and South Korea that are now staring down the barrel of a 100% energy blackout. While the geopolitical theater provides the noise, the price action in the physical markets provides the signal. We are currently witnessing a phenomenon that many macroeconomists have warned about for decades, but few believed they would see in their lifetime: the total decoupling. This is the moment where the physical metal, the stuff you can drop on your foot, completely separates from the paper price manipulated on Western exchanges like the COMEX or the LBMA. When Western markets closed on Friday, silver was sitting at roughly $93, gold was hovering near $5,278. These numbers are what I call polite fiction. They represent a world where people still believe in counterparty signatures and digital promises. But over this weekend, as the source code of the world broke, the informed money in Asia and the crypto-physical rails showed us the true value of assets when necessity replaces sentiment. In the dark markets, unregulated, peer-to-peer, and high-stakes gold touched $6,000 per ounce. This isn't a theoretical forecast. This is where actual transactions took place while the New York bankers were asleep in their Hamptons homes. If you want a more visible indicator, look at PAXG, tokenized physical gold on crypto rails. Because crypto never sleeps, it acts as the world's real-time price discovery mechanism. Yesterday, PAXG hit $5,600. Currently, it is trading around $5,400. That is a $124 premium above Friday's official close. The arbitrage here is screaming. The market knows that when the opening bell rings on Monday, the paper price must chase the physical reality, or the system collapses into a black hole of empty promises. If gold is the safe haven, silver is the shortage play. And the data coming out of China right now is nothing short of revolutionary. China's Dashong Bank has already issued a notice that if the price deviation becomes too large, leading to the depletion of accumulated gold liquidity, they will simply close trading. This is a bank admitting they are running out of the physical stuff. In the physical hubs of Shenzhen, the silver buyback premium shot up by nearly $20 per troy ounce. This puts the physical price in Shenzhen north of $120 per ounce. Shanghai Spot, 105. Shanghai Futures, Santwit dollars. IG Weekend Spot, near $100. Western Paper Close, $93. We are looking at a $27 premium in China for physical silver over Western paper contracts. Most small distributors in China have completely stopped selling. They aren't holding for a better price. They are refusing to sell because they know that in a world of drone-swarmed ports and frozen shipping lanes, there is no replacement supply coming. What we are seeing is financial warfare in its purest form. For years, the West has suppressed the price of metals through paper leverage, selling 100 ounces of claim for every 1 ounce of actual gold in a vault. This works fine as long as the world is peaceful. But when a black swan like the decapitation of the Iranian leadership occurs, everyone wants the 1 ounce of metal, and no one wants the 100 pieces of paper. The Asian markets are essentially calling the bluff of the Western banking system. If you are a physical buyer in Shenzhen paying $120, you aren't going to sell your silver for $93 just because a screen in London says that's the price. You are going to wait for the Western market to break. Miles Macro Insight. The premium isn't just a number, it's a measurement of the lack of trust in the Western financial system. The wider that gap grows, the closer we get to a systemic reset. Underneath all of this, the structural deficits haven't changed. Silver has seen 10 consecutive monthly green closes. Industrial demand from AI data centers, 5G, and military defense is hitting a wall of zero supply. When you add a regional war to a structural shortage, you get a vertical move. Tonight, when the Western markets open, watch the gap size. If the Shanghai premium widens past $27 on silver, the arbitrage will become impossible to ignore. The paper illusion is evaporating. If the Strait of Hormuz is the carotid artery of the global economy, then Asia is the brain that it feeds. While Western commentators focus on the political drama in Washington or Tel Aviv, the real economic tragedy is being written in the port cities of the East. These nations, the industrial powerhouses of our modern world, account for roughly 69% to 75% of all crude oil flows through the Strait of Hormuz. When that artery is functionally frozen by insurance hikes and drone swarms, the Asian contagion doesn't just spread, it paralyzes. This isn't about a slight increase in the price of a gallon of gas. This is about the survival of entire national GDPs. Japan is perhaps the most vulnerable nation in this new no red line reality. Japan relies on the Strait of Hormuz for a staggering 75% of its oil imports. But the situation is even more dire than that. Japan is nearly 100% import dependent for its total energy needs. As I speak, Japanese tankers are already turning back. They aren't waiting for a missile to hit, they are responding to the source code of the market, the insurance refusal. For an island nation that runs on just-in-time energy, every hour the strait remains frozen is an hour closer to a national blackout. Japan's industrial output is effectively on a countdown clock. The story is similar for the rest of the tiger economies. South Korea gets 60% of its crude through Hormuz. Their high-tech manufacturing, the semiconductors and batteries the world relies on, requires a stable, constant flow of energy. That flow has just hit a wall. India. sources 50% of its crude imports, roughly 2.6 million barrels per day, from the Gulf states, plus 60% of its natural gas and LNG. Watch the Indian rupee. It is under immense pressure as we speak. When India has to pay war risk prices for energy, the currency devalues, inflation skyrockets, and GDP growth is hit directly. This is how a kinetic war in the Middle East turns into a poverty crisis in South Asia. Then we have China. China is the largest absolute buyer, taking 55% to 60% of its crude imports via the Strait. On paper, they should be the hardest hit. However, China has been playing the long macro game for decades. Through their pipeline deals with Russia and land-based Silk Road initiatives, they have diversification that Japan and India can only dream of. But don't be fooled, China is still feeling massive price pain. They are absorbing the shock better than others, but their Shenzhen premium on silver tells you everything you need to know. They are bracing for a world where global shipping is no longer a given. China's order for its citizens to leave Tehran wasn't a suggestion. It was a signal that they know the kinetic phase is only beginning. Macro note. When the world's most critical energy choke point freezes, the importers take the hit first. We are watching the repricing of the global tanker fleet in real time, and Asia is the one holding the bill. In an environment of financial warfare, 99% of the assets in your portfolio are distractions. They trade on sentiment on how people feel about the next Fed meeting or a corporate earnings report. But in a world where the Strait of Hormuz is closed and regional leaders are being assassinated, sentiment is a luxury we can no longer afford. Only 3 assets matter now because these 3 trade on necessity. Gold is the only asset that isn't someone else's liability. When the U.S. Fifth Fleet can't protect Jabel Ali's cranes, and when insurance companies stop covering the transit of wealth, gold becomes the only source code of value. We are seeing a safe haven flow that is bypassing the traditional banking system and moving directly into physical and tokenized gold, PAXG. Gold isn't just going up. It is being revalued as the foundation of whatever system comes after this. Silver is the asymmetric weapon. It is simultaneously a monetary metal and an indispensable industrial component for the 21st century AI, 5G EVs, and military defense. We were already in a structural deficit before this war. Now, with the Shanghai premium at $27 and mine supply unable to keep pace, silver is no longer a trade. It is a necessity play for the survival of high-tech infrastructure. You can print trillions of dollars, but you cannot print a single barrel of Brent crude. Oil is the master commodity. When 20 million barrels per day are frozen, the cost of everything from the bread on your table to the shipping of your Amazon package goes up. Oil is currently experiencing a violent negative supply shock, and as long as the functional freeze of Hormuz continues, the price floor is moving higher every single day. Everything else is noise. These 3 are the signals. As we approach the opening bell of the Western financial markets, we are standing on the edge of a new financial frontier. The data is clear, the signals are loud, and the source code has been exposed. While the COMEX and LBMA slept, the physical markets and tokenized assets spent the weekend performing real-time price discovery. We are not looking at random numbers. We are looking at the informed money valuing assets when paper intervention is impossible. When the markets open tonight, do not expect a smooth transition. Expect a gap. A gap occurs when the price of an asset jumps from one level to another without any trading occurring in between. Given that gold is trading at a $124 premium on PAXG and silver is carrying a $27 premium in Shenzhen, the futures markets are facing a mathematical ultimatum. Either they gap up to meet the physical reality, or the arbitrage becomes an unignorable black hole. If the paper markets open significantly lower than the physical price, every smart player in the world will buy the cheap paper and demand physical delivery. This is the short squeeze of the century waiting to happen. The banks have coordinated slam-downs during geopolitical events before, but they have never done so against a backdrop where the world's most critical energy choke point is functionally frozen and the leadership of a regional superpower has been decapitated. Because honesty matters at Miles Macro, we must look at the resistance case. Could this de-escalate? The gap and fill. Sometimes markets gap higher on fear, only for the smart money to sell into the hype, causing the gap to fill or return to previous levels. Insurance recalculation. If the U.S. Fifth Fleet manages to secure the strait and insurers feel the risk has peaked, premiums could compress. Diplomatic backchannels. While no red lines is the current rhetoric, the global system has a way of trying to preserve itself at the 11th hour. However, hope is not a strategy. Even if the immediate kinetic strikes stabilize, the structural deficits in silver and the monetary distrust in gold remain. We have seen 10 consecutive monthly green closes on silver. We have seen gold hit 7 straight records. The system was already breaking. The events in Iran are simply the catalyst that accelerated the collapse of the paper illusion. As we move into this volatile week, remember the 3 assets that matter: gold, silver, and oil. Everything else is just a bet on someone else's stability. Watch the gap. If gold and silver futures open with a massive gap and hold those gains, the old pricing regime is dead. Watch the Strait. If the 150 anchored tankers don't start moving, oil will not give back its weekend gains, it will double down. Watch the Shanghai premium. If the gap between the East physical and West paper continues to widen past $27 on silver, the Western exchanges are functionally irrelevant. This isn't financial advice. This is financial warfare education. You are watching a systemic reset in real time. The physical buyers in Asia paying $120 for silver aren't selling at a loss just because a Western bank wants lower prices. They know what's coming. Do you? Follow me on X, formerly Twitter, for real-time updates as the gaps open. If significant data drops, another video or deep dive report will be coming fast. Stay sharp, stay grounded. Invest with logic, not hype. This is Miles Macro, out and about.